brief introduction. CA Pratiq Shah is a partner with Deloitte Huskins and Sales LLP, based out of Mumbai with over 20 years of experience in professional services firm with 2 years of experience of corporate experience in manufacturing, mining, automobile and IT sector. Majorly, he leads the following initiatives for Deloitte India: Digital for Assurance, ESG for Audit Assurance, Lead Partner for Accounting Reporting, Integrated Reporting for Deloitte India. So Pratik is a chartered accountant, certified public accountant and a commerce graduate from Mumbai University. Let us welcome him with a huge round of applause. Just a minute. I'll also like to present a memento to him.
Me well? Yeah, 109, 103, I think it all takes a toll. Just give me a call on my guy, we'll work it on that. Is it too much? Okay. Is this audible now? Good. So, considering that the state you are in, I just thought I'll change the flow of the slides, change the way we discuss. If it was 2 years back, I would have said that 115, 116 is something new. But I'm sure most of you would know what 115, 116 is, right? But it's always very good to go back to basics. And then the way I have understood standards, I've done standards all my life. There are some colleagues in the room with whom I worked. Akash was one of them. I was just sitting here, we all work together. The way I look at accounting standards is not by just reading them, not by just going through them, but understanding why a standard was brought out. So I thought I'll spend some time on that because it makes the understanding the standard, implementing the standard much more easier. So coming to, we'll start with 116 on the lease side. Excuse me. You have the slider. If you look at 116, how many of you know how many years 116 took, or IFRS 16 specifically, took to come to life? 3 years? Okay. Who else? Anybody else? 15? 3, 15, we have a broad range. We can. Anybody else? Any different number? So it took around 12 years to come to life. The draft took so much of discussion But the discussion beyond was around 5 years. So around 17 years it has taken the standard to come into force. Why? What was the trigger point of this standard? Does anybody know what was the trigger point of this standard? Genuine trigger point. It is talked about as a joke. I really don't know how true or false it is. I think it is the ex chairman of the Accounting Standards Board, or the IASB. He was going through an airline, or he was traveling through plane, and coincidentally he was going through the financial statement or the annual report of that same airline company, and he asked the question, where is the plane I'm traveling in? That's the source why this standard was brought in. I'll give you an example again why in the Indian context it makes sense. Now, most of the retail companies that you see in India, you talk about any of the retail company that you have, they generally have the entire mall. If you talk about malls, you talk about hotels, they generally have a lease model, right? And there are very few companies who have a complete own model. The same business model, they are not making money from the property. They are making money by use of the property. Same business model, but if you look at both the financial statements separately, you will find a very different answer. That's where the entire piece for getting all liabilities and assets which are outside books on your books was initiated. Again, let me tell you, we all have focused on the assets. The focus of the standard is actually on the liability, and the asset follows. What it says is, you have a committed liability for X number of years for paying your lease rentals. By not accounting for it, you're actually showing your liability in a very subdued number. You have signed a contract, right? A lease contract is a signed contract. You have to make that payment unless you cancel the contract. Till the time the contract is in force, you are going to be held responsible to make that payment. So you are there, you have to make the payment, and that's why the liability is the main point. And then because of the liability, how do you offset it is by the asset, which is the right of use. So this is the crux of the standard. The entire standard was built on this phenomenon and why it was brought in. Now, when we look at the objective and scope, I think we have covered why it was brought in. But the way the standard has been designed, and there is one more very critical element they have brought up in the standard. What is the main principle that you apply? You all of you said, right? You did 103 today, 109. When you look at 109, when you look at 103, what is that one principle that keeps on coming time and again? Control. They also wanted to bring the element of control into the lease assessment. So when they have come up with this flow chart, where you talk about how you identify a lease, the element of control had to be brought in. And that's why it again was very synonymous in terms of getting the entire flow of your accounting standards in the stream of control. If you look at your 110, if you look at 111, 112, all standards are now based on control, and then they wanted to make it consistent and hence brought the control element. Now, the flowchart that way is very, very simple. It also very clearly says, not says, but the interpretation somewhere very clearly says that the first and the second are the ones that you might be able to get out of. But if 1 and 2 have been selected as a yes, the third one is almost a given yes. But having said that, all the three need to be met for you to say that it's a lease. Now the conditions are very simple. You need to have an identified asset. Now what is an identified asset? I think it's again many cases very explicit, and in many cases it's not so explicit. So you have to really apply your knowledge, your judgment in deciding whether it's explicit, not explicit. So it becomes a very important aspect in terms of what an identified asset is. Second one, it says, do you have the right to obtain substantially all the economic benefits? Now again, this is generally very easy to decipher if you have taken a mall, if you have taken a floor on lease. But where you are taking a factory on a contract manufacturing, this becomes very subjective. If you have taken a vehicle for, let's say, so let's say many companies take up buses and vehicles for their employee transit. Are you using it entirely for you? I think that's where the second element comes into play. But overall, I think it's generally a very easy question to answer. The third is where you really have to apply a lot of judgment. Does the customer, the supplier, or neither party has a right to direct how to use the asset for its use? Now, this is again going back to the principle of your control. Who controls the asset? Now, there are n number of examples. How many of you have read the original standard, IFRS 16? None? The IFRS 16, and I'm not talking about the standard. If you have read 116, IFRS 16 is similar, but when you read IFRS 16, you read the basis of conclusion and you read the examples given in the standard. They are part of the IFRS 16 standard, but not Ind AS 116. Those standards give you, so example 1 takes you in this direction. A very similar case in example 2 will take you in this direction. So you take some time out, read the examples in IFRS 16. It will help you understand what word can help you tweak an agreement in either which. Now, so what I thought was, let's not spend a lot of time discussing theory. As I said, it's end of the day. We'll just talk about some examples. In these examples, I'll walk you through what could the implication and how it was decided. So I'm sure this is legible, right? Can you just answer, does the customer have the right to use an identified asset? Again, when you are looking at the standards, it's very important to understand the industry. I have worked with the telecom industry significantly, so I know how this business works, and you know exactly which way you can get the answer. When you look at the entire fiber business, right? How many from telecom industry here? When you look at the entire fiber business, there are threads of optical nerves going to the fiber, right? And depending on how you choose the contract, you can get an answer to this. You can have one contract which says that 10% of the capacity of that fiber you will use. And because the traffic moves through any of the fiber, it's not in your control when you switch on, switch off, which fiber you are selecting. But if you choose the contract other way, that this particular threads in the fiber I will control, your answer becomes an identified asset. Right? That's why understanding which industry you are, how the asset could become identified, not identified, becomes very, very critical in terms of the industry. And I think industry specializations are going to be very important. With that, does the answer, can somebody just try what the answer to this is? No control. You do not, the control comes later on, sir. Right now we are only talking about identified asset. And the control is still later on. You may have control, but if it's not an identified asset, it doesn't matter. Now, this is on the flip side. As I said, depending on the industry, in this case, you have got control of a particular thread. You are deciding when to switch on, when to switch off, when to throw the data. So in this case, it's going to become a identified asset. Now, this is around the substitution rights. So in the identified asset, there is a very specific clause given that the asset could be identified. So let's say if you have taken from me flat number A on rent, but the clause in the agreement very clearly says that I, as the lessor, can substitute flat A with flat B, right? That's a right of substitution. That's a right with me. That could take you away from saying that this is an identified asset, because the right to move you from an asset is with me. Okay. Now here it says, I'll come to the point which is trying to highlight. It says there's a tower, you have space on the tower, and the owner of the tower can move you from slot A to slot B. Now, the standard again calls out that in this substitution right, you have to look at the aspect of practicality and the cost involved. Now people could go. So let's say you with Mindspace, you pick up a particular floor. Mindspace, considering their bandwidth, would say we have the right to move you from floor A to floor B. But there's a clause involved which says that the furniture and the decor that I have done in my office, you will do in other office itself. While the first clause gives you the right, the cost involved to move that entire decor is actually prohibitive. So it doesn't make it practical to make it substantive. So you have to apply the judgment. It's not only by the word given in the contract that it's a right to substitute. You'll also have to look at how practical and cost efficient that is, which again the judgment part comes into play. In this case, again, from a tower standpoint, in the telecom tower, it's very, very painful to move the assets from one tower to another. There's a whole host of machinery behind it. It's not as easy as it seems that you just move one dish from one to another. Now, this was another aspect which came in, and again, I try to simplify by examples which are very simple to understand. Again, the life is not so simple, but when you're explaining a concept, it's very easy to explain by a very simple thing. You have, let's say, three options. You have one option which is only take a car on rental from somebody else, the way it works with Zoom car. Second, you have the option of taking a car and a driver, the way it works, let's say, with the likes of Avis or cars on rent, somebody else like that. What's the difference between both of them? One, Zoom car, you have just gone online, taken a car. The car is for you for X, Y, Z days, months, what you want. Second is you've gone to Avis or the cars on rent, they have given you a car. What's the difference between both of them? In the first one, you only get the car. In the second one, you get the car and the driver, right? Now, that's where the standard said we need to understand what we are getting. And you are getting in the second one, a driver and a car. So it says this essentially has two elements. It has a lease component, which is the asset, and a non-lease component, which is the service of the driver. It gave you an option. If you want to split, how you do it. If you don't want to split, it's your choice. But it again made it very clear that if you are doing it for a particular class of asset, you have to do it for everything. Now this concept becomes important because you then need to understand the implication of this standard on your financial statements. Now, how many of you know what happens because of this standard to your balance sheet? Balance sheet size increases, goes down? Increases on both the sides. What happens to your P&L? So that's right, because you are replacing the lease rental cost, which in the earlier standard was straight lined, you are replacing that by the lease interest expense and depreciation. And as we all know, the lease interest expense in the initial year would be high. The depreciation again would be on a straight line basis. So your expense would go from high to low. And you remember, you are not talking about a business which will start today and end in 10 years. You're talking about a business which will continue. So your leases will have to perpetually be renewed. And hence, a higher charge is already going to hit you. So if you go on this standard, your charge to the P&L will be higher. And that's where the choice of splitting the lease, non-lease comes into play. Why? If you split the lease and non-lease, in this case, the driver cost and the car cost, the driver cost can be taken to your P&L as a cost on a straight line basis. But if you take it as a lease, as an overall concept, it will increase the asset, increase the liability, and also have a higher hit cost. Okay, that's where this option, the way you choose, you have to choose with the implication. So I have, when we were implementing this standard, I've worked with telecoms, I worked with manufacturing, I worked with even hotel industry. We actually had to work out in all the three models. There are three transition options. I think now I'm not going to talk about the transition options. Most of the companies have gone on the journey, so we said we'll save time on that. But in the three transition options, we had to give an impact exactly what happens to your P&L, balance sheet, reserves on day one if you do by option 1, option 2, or option 3 in the transition. That's where understanding what happens, why lease, non-lease, how you segregate, and then the potential impact on your P&L and balance sheet was to be shown. Now, how you do it, again, was a very simple concept. They borrowed from Ind AS 115. We'll talk about that when we talk about Ind AS 115. Ind AS 115 brings in a concept of allocating value based on its relative fair value. Right? So it says when you are segregating components between the lease and non-lease, use that relative fair value component and then allocate between two values and put it across. Relative fair value is nothing but if you had to take that service separately from the market, what price will you pay is the relative fair value. The standard, the way it is from a lessee, so the standard actually from a lessee standpoint changes the world of accounting. From a lessor standpoint changes very less. Okay, from a lessee it had basically it said you bring everything on the balance sheet, don't keep anything out, but it said we need to bring in some simple principles of ease of business, and that's why it gave you two exceptions. One was leases of low value and second was leases of short term nature. And when it says lease of short term, it explicitly said leases of 12 months and less, and low value they kept it open. Again, like any other standard under IFRS, in the basis of conclusion they put a number of $5,000. It was not sacrosanct, they just put a number as an example. People followed that to a great extent, but there are many people who have taken a very higher number as well. I know companies who have taken 10, 20, even $50,000. If they had a $5 billion balance sheet, taking a number of $10,000, $5,000 was not making sense. So, but when we are doing this, the principle we keep in mind is, let's say we're talking about a IT company. IT company's main asset was laptop. We didn't allow them a number which would keep the laptops out. That's their main plant and machinery. Right? If you are in a let's say manufacturing, laptops are only a aid. So that way, I think the answers could depending on the industry you are in. The second, the three principles which you have to be very mindful when you talk about the standard of leases. One is the lease term. Second is the discount rate. The discount rate, let me tell you, 100 basis points could change your number world across, because you're not talking about 2-3 years, you're talking about 10, 20, 30 years. I was doing a lease of the lease assessment of a hotel, which is a 100-year-old hotel. And when we went back, we realized there is a continuation sheet also beyond 100 years. A 200-year lease which we found. We said we'll not do it, we'll take the easiest option for the transition. It was not practical. So the lease term is a very important aspect. The discount rate becomes a very critical aspect because it could change the balance sheet number significantly. And the third one is what amount you capitalize. Now the lease term, again, in the old standard, when you had the option to record as finance lease and operating lease term was not so important. Can you tell me why? I'm not saying it was insignificant, I was saying it didn't make a lot of impact. Can you explain to me why? Old standard, ROI was not there. In the old standard, most of the leases qualified as operating lease. So the only difference that would have come with the tenure being shorter or longer is the impact of straight lining. As an impact on your P&L or your balance sheet, it would not have been even 5%. So people just let it go. They didn't focus a lot on it. Now that changes the entire paradigm. If you have taken a 5-year lease and you record it for 5 years, the same lease shown by somebody else for 10 years, the answer is different. It is actually 2x, right? And that's why this lease term becomes a very important estimate if you are on a heavy leasing business. So that's where the focus, everybody asked me, in fact, when we were discussing with the people across the globe, and when we were talking about some accounting issues, they said, why are you debating this? This should not have been a debate because the lease term should have been consistent before also. We put it on an Excel sheet that it didn't matter to us. You take a 5-year lease, 10-year lease, 15-year lease, the impact of SLM was below my materiality. It really did not matter. So, but when you talk about this, how you bring your asset liability in your books, it's going to make a very, very different impact. So the standard divides the term lease. If you look at the 17 standard and the 116 standard, the definition is actually not changed much. Okay, as I said, the implication and the application has changed. But what they have done by bringing in the definition, they have brought in two aspects. You have to start with the period which is a non-cancellable. That's your rule of thumb. You start with that. But to that, you have to add the probabilities of you extending, the probabilities of you cancelling. And all of this will have an implication also on the ROU. Okay, so it's stated very clearly that what are the chances of you extending, what are the chances of you cancelling, what are the chances of you buying out. Please factor all of those and then come up with the lease term. Now, may not be a complex situation in most of the cases, but telecom, malls, hotels, this is a life-changing answer. So depending on the industry, the focus on the lease term changes. If it's a normal business, if you're in let's say you are just using cars, vehicles, some factory assets like the forklift or something else, doesn't matter much. It's not material. But if it impacts the big items of a balance sheet, then you have a significant impact coming in. Now this is where the yeah. So the question for benefit of all is saying that it's a 15-year contract, but both parties have a right to cancel in a 60-day notice. You look at it from various angles. One, what is the cost involved? What is the penalty of cancellation? Right? Because you don't take an asset. If it's let's say a car, doesn't matter. But if you're taking an office or a factory and you're customized for you, you will not have a clause which allows somebody to just take it over. So first, the asset decides that. Second, the cost of cancellation. Third, you then start with the basic non-cancelable period. In a 15-year, there will be a non-cancelable period. And then beyond that, if both the parties have a right, and it really logically makes sense, you will have to stop at the non-cancelable period, because then you do not have the unilateral right to extend. So that's the general view people take. But as I said, the answer has to be on a case-by-case basis. Now, this is what comes in. If you remember, I mentioned very clearly, the concept was a lease liability, which flows into your asset. So what do you factor as a part of your lease liability? First is the expected residual value guarantee. There are leases where the lessee would have committed to the lessor that at the end of the term, I'll pay you X amount. You have to factor that amount. So it's not only, what the standard says, it's not only the lease amount that you are factoring, you have to factor things beyond that as well, which you are committed to pay. First is the expected residual guarantee that you are going to give. Second is the penalty for termination. Now, what is this? I mentioned, right, when you're looking at the lease term, you could say that I have entered into a 10-year lease, but I know that in the 7th year I will be good, I have enough cash, I'll buy my own land, and I'll terminate this lease by paying this penalty clause. If that's the estimate you're making, please ensure that that termination cost also goes as a part of your right of use. Index rate variable payments. This was something which was a lot debated, but finally got added. It says if you have, so you all know, right, variable payments are kept out of the lease payments, right? Variable payments are payments based on some activity, right? So in fact, in a mall, if you have a payment which is based on total sales or footfalls or profit, those are termed as variable amounts. So they said we don't want all amounts to be dressed as variable and kept out, when specifically there are amounts which are linked to inflation. So what the standard says is inflation related amounts you please factor on day one. And let's say it's a 15-year lease, and the clause says every 3 years you increase the amount by the then interest rate or the inflation rate or the wholesale rate, whatever it is. The standard says don't discount this as a variable. You take up today's inflation rate and do that increment over every 3 years for the next 15 years. and at the end of every 3 years, please actualize it. So it says this is not a variable payment. You'll have to factor this and you'll have to capture as a part of your overall lease liability. Of course, the fixed payments of your leases, and if there is any final purchase price that you've agreed that you will, at the end of the lease term, you will buy the asset. This is your committed lease liability. That goes as a part of your liability in your books at its present value. This is the base for your right of use asset. But your right of use has to have something more as well. Why? Because it's an asset. And what are the elements you look for an asset? ARO. Right? If you look at Ind AS 16 says any right or asset retirement obligation that you have to factor as a part of your asset. So if you have any ARO liability for the lease, please add on to your lease liability. Second, if you have any cost which you are incurring to make the asset ready for your use, please add that. So which is the direct cost that you could have. And third, if you are making any payment back to the lessee, also reduce that. So these things, 3 things you add to your lease liability, and you come to your answer of your ROU. Bottom line, your lease liability and ROU may not be same in all situations. Okay, so this is the structure in which you build up your entire lease liability and right of use asset. Again, this is something which we all know. The lease liability you amortize using the amortized cost method. You load your interest, reduce your payments, and the closing liability then continues. You keep on doing on a year-on-year basis. The asset, you have the asset and you keep on doing the allocation of your reduction of your asset over the straight line, and also impairment if any. Lesser accounting, as I said, has not changed much. The principles of identification of the lease continue to remain same. The lessor still has the option of finance lease or an operating lease. Those who are exposed to US GAAP also has very different norms of accounting compared to IFRS or Ind AS. Ironically, the entire project of IFRS 16 or the new lease accounting standard was started as the first harmonization project between US GAAP and IFRS, and when the final standards came out, both were very different. So that was how the harmony came out. But so if you are doing US GAAP, the answer is different in some cases, especially from an operating lease standpoint, even from a lessee standpoint. US GAAP gives you some more leeway, but IFRS that way has made things very, very easier. Okay, any questions on lease accounting? You tell me what should happen.
I mean, I was thinking of, your ability to get out of a ROU asset is limited to maybe subleasing it or something, right? As opposed to own asset, which you can perhaps dispose of. I mean, it depends, right? From situation to situation. You can have an office space you've leased out, but you can't really make use of it for whatever reasons. So, should that be impaired more aggressively? Because you can't wait for like 5 years for for it to appreciate.
No, but the impairment standard doesn't follow any of these aspects. Be it your own assets or the leased assets, the impairment principles will remain same. Essentially, what impairment says, if the value you are expecting from the asset is lower than your asset value, please bring it down to that value. Simple. Then be it the leased assets or your own assets, it doesn't matter. The bigger challenge which comes up in the entire impairment assessment is the CGU concept. And where you pick up which asset for which CGU is a larger challenge than the impairment itself. So in terms of principle that you apply for impairment, I don't think it should change. It is the only because you are not the legal owner of the asset, it's given the name ROU. In all other aspects, it's an asset. So with that, any questions on here? Only one request, don't solve your office questions with this. We require some larger. Generally what happens in a situation like this, the questions which you are facing in your office come as a question. But if there are generic points, happy to discuss. possible, theoretically possible, but for me to assess and to come to the conclusion, I would look at many different points. I would first and foremost look at a business plan. Your business plan has to reflect that story. If a business plan is showing that this particular asset is going to continue for 10 years, I would not allow you to make it a 3 and 7 years. It's again all about intent. The idea is not to use the standard to reduce the accounting implication. So if you are very clear that I do not have a visibility beyond 3 years, you can go with that view. But in this 4th year or at the end of 3rd year, you will be posed a question now whether 2 years, 3 years, or I should go for the entire 7 year. And that's a question people have to be worried in, especially on listed companies, that the street is going to ask this question. Then why did you go wrong in the first place? So that's the thing you have to be very mindful when you are taking this particular assessment. Basically what you're asking, ma'am, is has accounting standard defined business? No. Business can't be defined by accounting. Accounting is to aid business. So where we have seen these tweaks is vehicle leases, where let's say you had a contract where you specified vehicle numbers. Now we have seen contracts change, saying that from your pool you allocate the car. So the identified asset is straight away moved out. Buses, we have seen that. We have given them the right for the other people to use it. But let's say I'll talk about an automobile company. They had 3 contract manufacturers. Because of this standard, they all became leases. They didn't change the contract. It was a matter of if they give them the right and they go to a competition tomorrow, the business is finished in those countries. So business can't drive accounting. But yes, you can have smaller leases worked out. Anybody else? So I'll tell you again what we have done. Like though company not having debt is probably it's like finding a needle in the haystack. Secondly, where we have the situation, in very few cases, let's say it was a subsidiary of a US company, it did not have debt, it was working on the capital infused by the parent company. We did 2 or 3 things. We saw for a similar company, what is the rate for debt available. We actually in many cases even asked the companies to go to the bank and get a rate of interest for a norm. But leases could be of multiple tenures. So we have not asked for that multiple tenures. We got that reference rate, which is in a way, I'll tell you in a way how it is derived. It is derived with the lending rate which RBI gives. To that they add the risk factor based on your rating, right? And that's the basis we have used. And then it's a 3-year, 5-year, we have used gaps. So let's say 3 to 5 years, we use same rates. 5 to 10 years, we use same rates. I think that's the reason, that's the way we have worked out. Very few cases where a rate was not available. So then you do, as I said, you do a benchmarking of a similar company in the market and then add a very ballpark number. So it's very safe, right? You all know a rate between 9 to 11% when the standard came in was fairly reasonable. So depending on the history, depending on some basis, we use the rate, and then they also have financial instruments. So what rates are you using? We somehow landed in the same rate. We did also a simulation that if you do 9.5 or if you do 10.5, how much does it change? And then we land somewhere in between. Any other? No? How many of you have actually worked on the computation of the lease accounting? Only 5 or 6. Others got work done. Okay. So the principle is in the computation is pretty simple. It's not it's not rocket science, right? But the challenge comes in terms of its enormity. We have I remember the largest deal that we worked on was 7,000 leases. it was a task in itself. So we had, again, the practicality of it is very important. How do you control this? At which point in time you decide whether we move to Excel or we move to a software? How do you decide the software? Again, the COVID benefits which came in, you know about the COVID benefits, right? There was the lease-free period, leases where the rents were just excused. How to keep those adjustments? I think the many things came in. So that's the important aspect from a control standpoint specifically. How do you keep a tab of any change that could come in? So let's say you have those lease elements which are changed by the inflation rates. How do you keep a tab on those? How do you keep those changed at the time in? Impairment assessments, how do you do? All new leases, how do you ensure that your discount rates are in the right places? And the most important, very, very critical, how do you ensure that the lease term is measured and corrected at every point in time? These are the practical aspects in terms of how do you approach the standard and make sure that you don't trip on any of these wires. Coming to revenue, again, as I said, my basics don't change. Any standards I look at, why this standard was brought in. And the history of this actually lies more towards US GAAP than IFRS. How many of you have worked on 115? Almost everybody, right? Everybody working is dealing with revenue. Why was the standard brought in?
I think longer term commitments given to customers.
No, you had standard for that earlier. What was the single, yeah? Sorry? Fraud तो आज भी होना है, करना है तो. There you go. US GAAP around 7 standard on revenue. Different type of revenue or different standard available. Plus, I don't know how many of you know, US GAAP has hierarchy of standards. So a same accounting piece or a same accounting judgment on a type of transaction could be given by a higher authority and a lower authority, right? So you have to then follow the higher authority. So it was getting too complicated, too confusing. Same way when you talked about the Indian GAAP side or the IFRS side, we had the contract or the standard for revenue on sale of goods, then we had the real estate contract, and then something else. We had a paper on customer benefits, loyalty programs. That was getting too much. The interpretations were getting very, very diverse. So if you have looked at this lens from this contract from a particular lens, when you apply the same lens and judgment to another situation, your answer changed. That's where they thought that we need to come back with a situation of having only one standard that answers everything. And I think they managed by this contract very well. Again, on a practical side, not many companies, there was only in India, if I remember well, only one type of industry got impacted highly with this. Do you know which one? Real estate. It really got impacted significantly. Others, I think, not major. IT, where they were following some stringent standards from a revenue recognition, it didn't change much. It in fact only aided that accounting that they were doing before. Others, if it corrected things, I would not say it impacted, because if you know, right, when we went on the Ind AS journey and when you read the accounting policy for revenue, it only says revenue recognized when goods dispatched. Nobody checked when the risk and rewards are transferred, when the control is transferred. That was a very standard accounting policy. The standard just brought, please check when the risk, reward, control is actually transferred. That's the point in time when you recognize revenue. The way the standard has been designed is a very simple 5-step model. Now, if you are looking at any contract, let's forget accounting standard, When you are looking at revenue or you get into a deal, you sell somebody something or you buy something, what are you looking at? The standard just tried to replicate that 5 steps. Nothing else, if you look at it. I don't know how many of you have thought from that angle. The first and foremost, because you are dealing with a corporate, you need to have one element, which is a contract in place, right? Now, everybody could argue that we all have read the Contract Act when we are doing CA, that even a verbal understanding could be a contract. So if you can take it into a court of law, God bless you. But generally the answer when we are looking at, you need to have a contract in place, which is a signed document. It is there. It is there. Absolutely. So it doesn't say the 5 steps the way I'm talking about. I'm not here to just talk about the standard, but it's the way it has been brought in. I'll talk about. So first it says, I'll just talk about it. First it says, you please identify there's a deal between you and a customer, right? It says this is between a party and a customer. You need to have a customer in place. So you have identified you and party X. The second thing which comes in is, what is your obligation, right? You are selling him something. So it says, you please identify your obligation. Here the element which gets captured is, what are you giving them? Is it 1 element, 2 element, 3 element, or more than that? Okay, that's the second part. Third part, it says, now determine at what total price are you giving it. So first we agreed to trade. Second, I identified what I am actually contracting to give you. 1 piece, 3 piece, 5 piece. Third, at what total price? What total price? And the fourth one, allocating the total price to the second one, which is my obligation. Right? So that is the fourth step. And the fifth step is all those obligations and the revenue mapped to it. When should I recognize? Simple. It's, you don't need a standard. I means we CA, we are banyas, we know this is how we deal. The standard only replicated that model. It brought in those rules, it brought in those interpretation challenges, but in essence, it only brought this simple 5 steps. Now, where the confusion comes? The biggest confusion comes in the second option. How do you identify what are your obligations? Third one is relatively easier because you know the total price. Fourth one again becomes slightly complicated because you have to allocate that value to the elements. And the fifth one is where the biggest judgment comes in, where at which point in time you recognize revenue. Now, if you know the old standards, by definition, it was at a point in time. Now, this standard gives you 3 conditions. If those are met, you recognize revenue over time. There are two principles for recognition of revenue. Revenue recognition over time, that's over a period, or at a point in time. So the standard says if these 3 conditions are met, I think it's 25 A, B, C of 115. If those 3 conditions are met, you do it over time. If these conditions are not met, it's at a point in time, right? And at a point in time is generally at the fag end. It is not allowing you to prepone revenue. So this is where the standard got devised, drafted, and implemented. Now from a real estate standpoint, it started hitting high because there were many corporates, many companies. I'm not talking about listed, I'm not talking about any other company specific, but they generally tended, so let's say there are various schemes, right? And there are, if you go in the remote part of the country, there are people who say, if you are selling the flat at 3 crores, I am giving entire value upfront, you give it to me at 2.5 crores. Right? These deals have happened. Real estate started recording the entire 2.5 crores as revenue on day 1. But you have to still deliver the flat over next 3 years. This challenges started coming in because a standard made it very clear that you are not giving the commitment as a sale. You are giving a flat as a sale. So unless the flat is delivered, you cannot recognize revenue. Second question came in, when should I recognize revenue? For a flat, ideally, I'm recognizing revenue because the conditions, the way they were, the 3 conditions, it said 1, you should be doing something which is accreting value to the end customer. Second was, the value should be transferred as and when you are creating the asset. And third, you should have the right over the asset and you are getting payments over it. So these 3 conditions when you look at, and every, while we look at a real estate dealer, we only see there are 2 or 3 standard contracts. There's a subvention scheme, there is the scheme for construction lien payments, CLPP, and there is an upfront payment. But there are nuances in every contract. Most of them got fit into the situation of doing it over time, because you are giving an asset which is accruing value. There is no right to substitute. You cannot substitute the asset, because if you have sold and you have constructed flat number 1303, that's your flat. It's a registered document. But then when we started getting deeper into it, we realized state-wise the registration documents are different. Let's say Maharashtra wants you to register the sale of flat in 30 days after you have made the token payment. But if you go to Andhra, there's no requirement. You can register at any point in time. So how did you start looking at what a commitment is? Because the question came in is, if I have not registered the flat, at any point in time I can walk out from the deal as a buyer. I said, okay, I'm not happy with you, I'm going somewhere else, you pay my money. RERA allowed that. RERA only made this more easier. So those were the cases that we had to look at a bit more differently, and that's where different answer came into place. There's no one answer to any contract. Every contract had to be seen differently. Here in this case, we know of companies going back and changing their legal deeds to ensure that they fit into the requirements of 115, and then the recognition of contract over time happens. Second challenge which came in is you can only recognize amount to the value of the work done, and that you have the right to collect. Where the second piece always fell into the cracks was the CLPP. When you say 15%, 12%, if it's a standalone building, made sense. But if it's a condominium, that percentage was not able to be traced. Right? If it's a building of, let's say it's a society of 7 buildings, you have a small flat in one of the building, all of them are 25 floors. So you're talking about X number of flats, and he is given a random percentage. How was that computed? That computation and getting that comfort in terms of have you met that threshold was a bigger challenge. So this where the pieces from a real estate standpoint really started impacting. But I think most of them have either changed the contract or gone back on a very conservative accounting and changed the answers. So this is the simple principle in which the standard has been devised. Okay so far? Yeah? Now we'll just again, as we have done earlier, step by step I've taken some examples. We'll try and discuss those together. So there is telco ABC. It simultaneously enters into 2 separate contracts with customer C. Contract 1 is a month-to-month contract for provision of voice and data services. And contract 2 is for the sale of handset and provides that the contract price of the handset will be paid in fully by monthly installments over 24 months. Full payment of the remaining balance of the handset becomes due as soon as the customer fails to renew its monthly service. Should these 2 contracts be combined? Before you answer, why is combining of contracts? Do you think if you have entered into 2 or more contracts with the customer, you should even give a thought to combining, or why? It's 2 separate contracts, account for it separately. How many of you think accounting for it separately is okay? Don't agree because I'm asking. No, there are 2 separate contracts. I'm not on the part of obligation. I'm saying there are 2 separate contracts.
If they are separate in real sense, then yes, they can be separate. But if they have a sort of an implicit connection,
So let me give an example, and I'm now stretching it, but we have done this, okay, and we have seen this. Now there is a group, there is company A and company B. Okay, company A, we can't do this for all the contracts, but these were 2 large contracts. This company was doing service X, second company was doing service Y. Separate companies. We had to look at the combining of contract at a console level. Why? So that's why I give you back to the point, why the concept of combining, again, that's why I said everything that I see from accounting standard, I try to first place why this is devised. You get into the head of the writers of the contract or the standard to understand what are they thinking. Then it makes sense. Why combining contract takes place? Now, how many of you go to market to buy things? All of us? Do you buy dhania? I don't, because मैं मिर्ची का free लेता हूँ. Okay, that's the principle. That's the principle why combining contract is important, because the pricing of 2 contracts could be argued whether you have subdued one price to get some price here. If both of them are fairly priced, there is no issue. But if one has been compromised and the pricing has been settled on the other, and it happens, client बोलेगा for this I don't have the budget, आप इधर price charge कर दो, मेरे पास इसका budget है, इसका नहीं है, इधर आप कर दो 30% discount पे, you charge me 140% here. Your revenue recognition goes for a toss when, let's say, this is overtime and this is at a point in time. Got the principle? And that's why combining of contracts has to be seen very, very clearly. And then when we are actually auditing, we have a very separate step to look at same parties and the time frame in which the contracts have been entered. That's a very important, because you will not otherwise realize this ever. Now you on the other side, I don't know how many are from the profession, how many are from the industry side. When you are also getting into, and most of us will be in the, not in the commercial or the sales side, will be in the accounting team. But this is a step that you can actually start discussing with your sales team on especially your large accounts that you have. So that's why the combining of contract is very important. In this case, what we are saying is Telco ABC determines that the two contracts should be combined because they were entered at the same time and same customer, and they were negotiated as a single commercial package. It doesn't make sense to account it as two, you show it as one single contract, right? And then we have this lot many places. We are doing implementation, we are then doing the support services as well. It always makes sense. The pricing is always done as one, right? So you combine that contract and look at it at that particular situation. Now this is important, which takes you to step 2 on identification of the performance obligation. You can just read it for 2 minutes. The crux is you are giving a SaaS, the software as a service, and there's also service associated with it. The fact you need to look at is that service which you are looking at associated can be given by some other party also. So for your standpoint, are this, now we are going back not to the combining part, we are looking at are these two separate obligations or not. So in your view, do this qualify as two separate obligations? Yeah, I think the standard again has been designed in a very categorical way, and it says when you hit a wall in terms of an interpretation issue, you have to look at it from a customer standpoint. The standard makes that very, very clear. So look at it from a customer standpoint, and if he's coming to you only from a way of making it easier for him, but he can anyways go out and get it somebody else. For you, you could say they are two different obligations and they are not linked as one. Now, this is another, a communications company enters into contract with the customer to provide wireless telecom services for $60 per month and a handset for $110. It also charges an activation fee of $40. The communications company sells handsets separately, for example, when a customer handset is lost, stolen or damaged. How many separate performance obligations you have? Two? So in today's world, two, but if I took you back to the Reliance world, when the first Reliance phone came up, what was called it? CDMA phones. Would the answer be different? It was combined. The CDMA phone couldn't be used with any other services, right? Then the answer would change. In today's world, the answer is different, because any phone is available. You can just put a SIM card of whoever. In fact, now the ek phone mein do alag-alag SIM card bhi jata hai. So that doesn't matter. So that's how you look at it. Again, it's situation. This is customized for today. Today, there are two separate obligations. Customer loyalty. Again, very important aspect in today's world, where almost everybody throws it back to the customer. what a customer, how many of you know what a customer loyalty is? How many of you travel by air? How many of you did travel by Jet Airways? The young people may not. Jet Airways, right? Jet Airways had a very nice loyalty program. Now I think it is there with Vistara. Others don't have. Air India has. But if you remember that loyalty program of Jet Airways and even Vistara, it says that every flight you make, you will get X points in your kitty. When those points reach a particular number, you can claim those for a free flight. Okay? Now I'm just simplifying that if the condition is that you do 10 flights and the 11th flight I give you free. What does that mean? You do 10 flights with me, the 11th flight will be free. I'm charging you over 10 flights for 11 flights. That means my revenue can't be recognized over 10 flights, but will have to be recognized over 11 flights. With me? Now this is the simple aspect. The complication comes in. The condition is very clear. You need to do 10 flights. Now there are many people who would probably do only 2 flights a year. They may not reach the 10 flights. Should they defer it for every flight? No, they should not. Plus, it's not, if let's say, even there's a frequent flyer, my father, let's say he's a frequent flyer, he will not know that he can redeem those points. He may not know. So the point I'm trying to bring out is, you will have to be very clear in terms of what percentage of that loyalty points you expect to accrue and be claimed. And the deferral of that revenue, you only do that impact. So this is a concept. I'll not get into the mathematics. Mathematics is pure 1 + 1 = 2. That's okay. But the principle here is, you identify how many people are likely to get that threshold, how many are likely to avail it, and then you decide on what the referral should be, right? So in simple terms, on the first flight, let's say you expect 5% overall, the first flight is 10,000 bucks, you will recognize revenue. The cash comes in debit 10,000, revenue 9,500, loyalty points 500. And when the flight is claimed, that royalty point gets into revenue, creating liability. Okay? So that's how the simple accounting works, but most of the companies now are into this, FMCGs get into this, airlines are into this, I think credit cards. So, but credit cards is different. Credit cards is different. They don't give you loyalty. They don't say that, boss, if you expend so much, I'll pay you back some amount. They give you gifts. That's an expense. Here, you have to differentiate between expense versus deferral of revenue. Credit card is an expense, right? So that's a very simple concept, but you are right. It has to be seen differently. Credit card is an expense. It's a marketing expense. Here, the revenue is adjusted. Yeah. So again, if you look at the standard, if you go to IFRS 15, you will get all these examples. If you look at any material, you'll get n number of examples. I'm not spending time explaining the mathematics of it. I don't think in this room I need to do it. But understanding the concept, if that goes through, it's a very simple piece. Now this is a concept which IFRS 15 brought in, the concept of significant financing component. We have always seen it from the other side, but we have not seen it from the revenue recognition side. Here the example is very simple. It says, I have got a deal with somebody, I'm dealing with him. I give him 2 options. It will take me 2 years to work. At the end of 2 years, he either pays me $5,000 or he pays me today $4,000. For you, should the accounting be absolutely the same? There's a clear-cut difference of $1,000, right? Why is the fellow paying me 2 years before? He's in a way financing me, right? So the way I should account for my revenue is, while I'm getting the cash of 400, my contract liability is not 400 or 4,000. My contract liability has to be increased for the next 2 years based on the implicit interest that I hit. So if let's say my cash was around 4,000, which has come in, cash debit to contract liability because he's paid me upfront. There is an element of interest which is going to get impacted. So over the two-year period, I'll accrue the interest by 494. My contract liability keeps on swelling. And at the end of the year, when I finish my obligation, in the first 20, there's no revenue. The revenue comes in the third entry. My contract liability, because the cash has come in, there's only a liability of advance cash coming in. I nullify my liability, and then I recognize my revenue. I'm sure we all know one thing, right? Because that's one big challenge we face with promoters. Cash and revenue are different. Are we aligned with that? Right? Promoters think cash is revenue, but that's not the case from an accounting standpoint. 100% they are different. 100% they are different. This is okay, we did that. We can skip. Yeah, so now this is one example of at a point in time. Company A sells goods on FOB basis. We all know FOB, CIF, FOB, right? Now things have become much more complex. How many of you have heard about what's called the very specific element? There's a very specific contract term used. If it clicks, I'll let you know. But CIF, FOB was the simplest one used, but now it has become much more complicated. You have terms like point of first handover, point of second handover. This happens a lot in terms of ship sales or high sea sales. So those things you have to factor. But for simplification again, the FOB CIF has been used. Company A sells goods on free on board basis, and the contract states that the title passes on to the seller once the company goods are shipped. Company A is responsible for any loss in transit. To protect itself from loss, Company A contracts with the shipping company for the shipping company to assume total risk of loss while the goods are in transit. Is it appropriate for company to recognize revenue when the goods are shipped? Okay with the facts? I'm selling to party A. It's going to take some time, but I assume the transit loss, but I have insured the transit loss that the shipper will bear it if something happens. So let's say I'm sending goods by truck or by sea. If something happens to this boat, the ship that is carrying, or the truck, the transporter will bear the loss. 100%. No argument. If you show him the loss paper, he will cut a check in your name. Can you say the sales are done? Yes or no? Do answer hai. Unless you want to choose the third option, don't know. No? Yes? Why no? I'm saying my money is secured. Is that the only thing? He says risk and reward are not transferred. Control of the goods is not transferred, right? So this stand again brings you back to control. This is every transaction is you have a rolling insurance policy, right? Insurance policy is only a cash flow mechanism. Your obligation decides when you recognize revenue. Obligation ends at your doorstep, or on the high seas, or at some other place, or at their shop. You need to look at those clauses and then only recognize revenue. On the last day of month 1, customer L enters into 2-year contract with Telco M for internet protocol television. We all know what it is. The customer L also purchases set-top box and installation services. Telco M has determined that IPTV services, the set-top box and the installation are 3 separate performance obligations. It has done that headache for you. There are 3 obligations: the set-top box, the services and the installation. What is it asking you for step 5? When you should recognize the revenue for each of them. You got the 3 obligations, right? The set-top box, the services of the TV and the installation. So let me ask you, when you recognize the revenue for the set-top box? When handed over, right? When the set-top box is under my control, done. All with me? Warranty is separate. Warranties is you you can decide on warranty on two aspects, right? Warranty, you make a just historical provision. You don't recognize adjustment on sale. When do you recognize the revenue on the TV services or the internet TV services? Over time, because you are delivering on a daily basis. The customer is getting benefited on a daily basis. It doesn't make sense. Even if I pay you for 5 years together, cash is not revenue because your obligation is delivered to me on a daily basis. If you stop it at the end of second year, you have the obligation to pay it to me. Okay. Third, installation. When the installation happens. Okay. So then that's where again the combining piece comes into play here. If it's 3 different contracts, you need to look at it as one contract because the pricing is structured as one. Real estate, I think we spoke about. I'm not going to get into this. This is complicated. This is a very important question. When we talk about it as principal agent, that's one way to look at it. The second way to look at it is gross versus net. Okay, and this is a very important question in many companies. You don't recognize, you don't know whether you should recognize revenue gross. And in today's world, when actually everything is happening on apps, happening through mediatories or intermediaries, you don't know whether the revenue number should be gross or net. And hence, understanding the concept of principal versus agent is very important. The bottom line is, if you are acting as an agent, you only recognize for your commission. But if you are the principal, you recognize full income coming in and full income going out, expense and the cost. Now, what differentiates the principal and the agent is a primary risk and responsibilities, right? If you are owning, so it's a simple example, and this is very clear in the pharma industry where you have the clearing forwarding agents, right? Or what we used to call in our old days as the consignee consignments, right? If the company has sent something to a consignee and he's only a custodian, he's only more of a warehouse, and he has no right to decide to whom to sell. He has no right to decide at what price to sell, or he has a very limited bandwidth driven by the company. If bolega last 3 days, you please give 10% discount, but maal nikal lo. He has no responsibility of collection. He has no responsibility of what happens to the products, of getting some new ideas. He is acting mainly as a agent. And the moment you say agent, he is only bothered about his commission. So this is how you do this assessment of principal versus agent in the various situations. But it's a very important one because it straight away impacts top line. It doesn't impact the bottom line. No change in the bottom line, but impacts the top line significantly and hence the valuation. So today the startups have a lot of arguments, or the new age companies, a lot of arguments on how to recognize revenue because their valuation is multiples of revenue. Right? If it's an EBITDA base, they're not bothered. But today there are companies who actually get valued on revenue, and hence this becomes a very critical point and actually a point where even a fraud can be perpetrated. So hence this principle of how do you identify what's a principal, what an agent, requires some huge amount of focus and considerations. So these are the risks which I talk about: inventory risk, credit risk, who manages the price risk. So price risk is what? That you are holding the stuff. When you got the price in the market was 100. Let's say you're talking about chips, and when I say IC chips, and in 2 days the prices have gone down by 40%. You are not perturbed. The risk is of the owner. You are again acting as an agent. But if that price risk comes to your doorstep, there's a challenge. This happens a lot in pharma, a lot in automobiles, a lot in all the new age companies. So that's where the principle is very relevant. Other companies, I think, generally which is happening on a dealership basis, most of them are on a principal basis. The dealers buy it and they sell it. They are not responsible for a sale to back. So there are some triggers that you look at. If the contract says there's a full-fledged open return policy, right? You can return the goods at any point in time. There's a big red flag for being an agent, right? So the written policies, how it's actually affected, how it's taken care of, is something that you have to be very, very mindful of. Contract cost, and this is something that the standard brought in again. If you remember in 18, Ind AS 18, we always had a big issue because the standard was silent on what to do on cost incurred very specifically to win a contract. Right? In today's age and world, you have to give commissions, officially I mean, you have to give commissions, you have to give contract cost, you have to give bonuses, you give commissions to your employees on this. All those put together, the old standard didn't say how to treat for this. And then when you say we go back to intangibles, it was again not talking about it. So it's somewhere fair within the cracks and eventually hit the bottom line. You have a long-term contract which is giving you benefit over 5 years. All the cost to hit the contract, get the contract, is taken in the very first year. This standard, that's why I address that. It says if you can identify, there are some conditions given, but mainly it says if it's a cost which is clearly identifiable, it's a cost which would have not incurred if the contract was not won, and only the cost after winning, not the cost to win. Okay, we be very mindful of that. And second, if you have a right to recover that from the client, you recognize that as a separate asset and amortize that cost as and when the revenue occurs. It's more of a balancing principle that you had, rather than having a subsidized initial cost on day one and the revenue coming over time. So this is the benefit the standard has given, a big time benefit for companies which are into construction, manufacturing like L&D, others. There's a big benefit which has come of accounting and referring this cost and deferring over some time to come. Again, some examples. So this was the critical element. I had to finish by 5:30. Sorry for going 5 minutes above. So this was the crux of the standard. As I said, if you understand the principle, it's not easy or not difficult to just implement it in a very, very simple. The nuance of the industry is important. So understand how the industry operates. Peer policies and peer practices also may play a very important role. But otherwise, it's a very commonsensical standard which has been prepared, and then application, it just follows the way you understand the business. So any questions, happy to take, or you're free for the day. I know again I'm repeating, it's a big thing, sitting for 5 standards in a day from what, 10 o'clock? Good Lord. Sure? You're not saying because you're in the first row.
Let's give a big round of applause for CA Pratiq Shah.